Good morning, traders, and welcome to today's daily analysis. Today is Tuesday, the 25th June 2024, and here are key things you need to know. Start with our US dollar index. On Monday, the US dollar index fell to 105.48 after experiencing a series of gains since early May. This dip came as investors decided to take profits ahead of a potentially turbulent week. Last week, the US dollar index was trending significantly better, nearing the 106 mark, a level we haven't seen since early May. The index has risen for three consecutive weeks, mainly due to the widening monetary policy gap between the Federal Reserve and almost all other G10 central banks. The US dollar has regained strength against risk sensitive currencies, largely influenced by the lower than expected inflation data in May. This initially caused a sharp decline in the US dollar, but also set the stage for recovery in buying interests. The investors adjusted their expectations following the Federal Open Market Committee meeting on June 12th. The Fed Reserve kept the federal funds target range unchanged at 5.25 to 5.50% and signaled only one rate cut this year, likely in December. After hitting a recent low of around 103.99 on June 7, the US dollar index bounced back, reaching a multi week high of 105.93, near the critical 106 mark. Looking ahead, if the US dollar index breaks through the June high of 105.93, it might test the psychological resistance area of 106 and the 2024 high of 106.51, last seen on April 16. Beyond that, we could see it challenges the November high of 107.11. On the downside, the key levels to watch are the 9-week moving average at 105.18 and 105 level. These will be crucial support points if the index faces downward pressure. And then for the WTI crude oil, on Monday, it firmed up, rebounding to around $82 after breaking through the $80 mark. The energy market remains volatile as investors hope for a rise in future demand, pushing the broader market higher, while also trying to manage current supply constraints due to the urgent demand. The WTI crude oil traded around $81 on Monday. The prices rose slightly amid ongoing geopolitical tensions in the Middle East and the expected recovery in oil demand during the summer. Investors are concerned about potential wider conflict in the Middle East, which would impact crude oil transportation and boost the WTI prices. Additionally, the demand for fuel used for food and travel is expected to rise in the summer, providing further support for WTI in the near term. Moreover, the strengthening of the US dollar following the release of the US and S&P purchasing index data for June and the hawkish stance for Federal Reserve officials may also boost WTI prices. The Fed policymakers have indicated that they need to see more progress on inflation before cutting interest rates. The prospect of longer term higher interest rates in the US continues to pressure WTI as it increases leverage costs, thereby suppressing economic activity and oil demand. From the daily chart, we can see that the WTI crude oil fell from a high of $82.12 last Friday to around $81. The 14-day RSI and the stochastic index has just turned down from the overbought area, suggesting that the oil prices may continue to fall in the short term. The key support levels to watch are $80, which is the market psychological level, and the 200-day moving average at 79.08. If the prices drop further, the next support for level is at $78.33, which corresponds to the 38.2% Fibonacci retracement of the range from 72.62 to 81.86. On the upside, the current resistance is at 82.12, Friday's high. Larger resistance levels are expected at 82.5 and $83, with further resistance at 84.14, the high from April 26. The gold prices rose slightly to 2,334 after a quiet European session. Despite Friday's sharp decline, the gold managed to hold its ground as the benchmark 10 years US Treasury yields struggled to push higher, and the US dollar weakened due to optimistic market sentiment. In the early Asian trading, On Monday, the gold prices retreated from a 2 week high near 2,368.8 to 2,325. The stronger than expected US purchasing PMI released last Friday put the pressure on gold. This week, all eyes will be on the final readings of the US gross GDP and core personal PCE price index, as the June US economic data showed mixed signals. The Minneapolis Fed President Neil Kashkari noted that it may take a year or two for inflation to return to 2%. Stronger US economic data and hawkish tone maintained by US Federal Reserve policymakers continue to support the US dollar, dragging gold prices lower. It's worth noting that the rising interest rates usually drag on gold prices as they increase the opportunity cost of holding zero yielding assets like gold. On the other hand, safe haven flows from geopolitical and economic uncertainties may boost gold in the short term. From a technical perspective, the decline before the end of last week can be seen as a failure to break through the 2342.25 resistance level of the 50-day simple moving average. However, the subsequent decline stalled before the lower support of the symmetrical triangle on the daily chart, which is currently anchored around the 2320 and 2308.70, making it a key pivot point. Given that the oscillators on the daily chart have just begun to drift into the negative territory, a convincing break below the aforementioned support level could push the gold below 2300 mark and retest the monthly swing lows around the $2,285 horizontal area. On the other hand, the 50-day moving average, currently around 2,342 area, and the 2,358 level may act as strong barriers before Friday's swing high around 2,368 area. If there is follow-up buying, the gold prices could move towards the intermediate mark of 2387 and eventually could reach round-up mark at $2,400. And this is all for today daily analysis. Thank you for watching and happy trading.